There's a math shortcut that shows up everywhere in retirement planning. I'll call it napkin math. It sounds reasonable, it feels intuitive, and it convinces a lot of smart people to make a lot of destructive financial decisions. Now, before we look at the data, here's a perfect example from one of the biggest names in personal finance.
Okay, I'm a little confused because I don't know what the hell George is doing a 3% withdrawal rate, because that's absolutely wrong. I'm going to have to find out where that video is and get it taken down. Because that's just wrong. You don't need to have a 3% withdrawal rate. That's ridiculous. Or I hope you misunderstood. I hope we didn't put out trash like that.
Was it 4 to 5%?
No, it shouldn't be 4 to 5%. It ought to be more than that. I mean, if you're making 12 in good mutual funds and the S&P is average 11.8, and if inflation for the last 80 years is average 4%, if you make 12 and you need to leave 4% in there for inflation raises, that leaves you 8. So I'm perfectly comfortable drawing 8. But if you want to be a little bit conservative, 7, but sure not 5 or 3.
Well, I was trying to back check it because, the 3 to 5, I thought that was a big range. And a lot of the studies I found showed.
Well, there's a lot of studies that are stupid in this space. So, it's just wrong. Listen, man, the math I just gave you is the math. If you're making 12% and inflation is 4, and you leave 4 in there, so your nest egg grows by 4, it's simple. 8 is what's left over.
Dave says the math is the math. Simple as that. And what he's describing is exactly what I mean by napkin math. This kind of math shows up in really big retirement decisions, like how much you can safely spend, but also shows up in other high stakes choices, like whether you should pay off a loan or keep the money invested and try to earn a spread on the loan rate. As Dave lays it out, here's how the math works on a napkin. Let's say that I have an investment portfolio I expect to average 8%. If I'm retired, napkin math says I should be able to take a 6% withdrawal rate without any trouble. I earn 8%, I spend 6%, I still have 2% left over. If that's true, my portfolio should keep growing even while I'm spending from it. The exact same logic shows up with loans. Suppose I have a $2 million portfolio and I want to buy a $400,000 home. If my investments earn 8% and the mortgage costs 5%, napkin math says there should be a clear spread and I should come out ahead by taking the loan and staying invested. But here's the problem and where this napkin math starts to break down. On the screen, I have a real-world simulation from 1973 to 1993. And then side by side, I have the same simulation using the same returns, but just in reverse. The simulation shows a retiree with a $100,000 portfolio drawing 5% as a withdrawal rate. Now, this 20-year period is a very favorable period for a 60-40 portfolio. Over these 20 years, this portfolio averaged 10.3% per year. Napkin math would show taking a 5% withdrawal rate should be absolutely no problem here. You average 10%, take 5%, you should still have 5% plus left over for growth. But here's the surprising finding in the simulation. If you started retirement in 1973, your portfolio would have been fully depleted by 1993. On the flip side, if you reverse the returns, effectively started in 1993 and lived life in reverse, your money would have tripled. In both cases, you are withdrawing the same from the portfolio, you are earning the same return, but the order and sequence of returns flips. And this is exactly the basis of where napkin math crumbles. Why does this happen? The basis of napkin math relies on the idea that returns happen in a straight line. If my portfolio earns 6 or 8 or even 10%, the assumption is that growth arrives smoothly and consistently year after year. And this is the assumption the foundation of napkin math is built on. To illustrate this, I've got a very simple table on the screen. Here we're looking at a $1 million portfolio growing at 6% per year with a 4% withdrawal rate and 2.5% inflation. In this simplified world, the math works. The napkin math works. The portfolio keeps growing even while taking withdrawals because there's roughly 2% still left over year after year for growth. On paper, this looks perfectly reasonable, but the entire table depends on that one critical assumption, that returns show up in this way in real life, and we know that they don't unless you're invested in a CD, a bond, or some other safe fixed income vehicle. And in those cases, we obviously wouldn't be able to achieve returns in that 6, 8, or 10% range. In reality, financial markets are volatile. You might be up 20% in one year and down 15% the next. It's the up and down movement that completely erodes the validity of napkin math. Here's another real-world example from New York Life, highlighting here what I mean. Here we're using the exact same sequence of returns from 2003 to 2022. The only difference between these two simulations is that we flipped the first and the last year. So again, not only do these two simulations have the exact same average return and the exact same withdrawal rate, they have nearly identical paths except for that first and last year. And as the chart says, 1 year can make all of the difference. So what is happening here exactly? When we introduce volatility into a portfolio, meaning a portfolio will grow at times and then retract at times, this volatility changes the outcome of your portfolio when you are withdrawing from that portfolio. For instance, in this simulation, after the first year, we have two completely different retirements. In this example, the retiree is withdrawing $60,000 per year. Using the orange line, this portfolio grows 29% the first year. And so after taking $60,000 out, this portfolio is still growing by more than 20%. So this retiree has something like 1.2 million. With the blue line, this retiree loses 18% the first year and then takes that $60,000 withdrawal. At the end of the year, they have somewhere around $760,000. So going into year two, because of the gap in portfolio values, the retiree following the blue line will be in a much worse situation. Both retirees earn 11% in year two, but 11% on a much smaller portfolio will barely cover that $60,000 withdrawal. 11% for the orange retiree will not only easily cover the withdrawal, but grow that portfolio beyond this. Every year from here, the gap just continues to grow because of the difference in returns in that first year. And so what we gather here, when we are needing to withdraw from a portfolio for income or even to pay off a loan, it's that volatility, specifically downside volatility, that can be quite destructive, especially in early years of retirement. This highlights an idea that you are probably familiar with, at least in name, and that is sequence of return risk. A lot of great retirement researchers have written about this concept and even run numerous simulations to show that returns matter most in the first 5 years of retirement. Some refer to this as the retirement risk zone or red zone. Suffer through some really negative returns in the last few years of retirement and you'll probably be fine. Suffer through negative returns in the first 5 years of retirement and all of a sudden your retirement will carry a heck of a lot more risk, whether you realize it or not. Now, it's important to note here that sequence of return risk works both ways. If you invest your retirement portfolio aggressively and the first 5 years of retirement are all really strong positive returns, a lot of data shows you will have little to worry about through the remainder of your retirement unless you make some really poor decisions later on. So the sequence of returns can certainly work out in your favor. The important element here is to avoid significant negative returns. The same logic plays out if we were taking out a loan or mortgage and trying to earn a spread from investing. The first few years of the situation matter more than the rest. Now, some of you might still be skeptical. It might seem like at this point I'm just cherry picking certain examples. You might be thinking that in general, growth rates are what matters significantly more. In accumulating wealth and distributing wealth in retirement, if I earned a high enough growth rate, I'll be better off. And even though napkin math might tell us this, real world math says the opposite. The sequence of those returns matters much more than the growth rate. I'll use real world data to prove this. On the screen, I have a chart where I'm using real world return data from a 60-40 portfolio from 1928 to 2024. I'm simulating 30-year retirements here. And on this chart, I've mapped out every 30-year simulation over this almost 100-year period and place it on a graph with the 30-year real return on the x-axis and the withdrawal rate that you could have afforded to take on the y-axis. So for instance, one of the highlighted dots on this graph is 1935. The 30-year simulation starting in 1935 gave an investor around a 6% return after inflation and supported right around a 6% withdrawal rate. Okay, so if growth rate was the main thing that mattered, we would see a pretty clean graph where as the after inflation growth rate increased, the saved withdrawal rate would also increase. But we don't really see that on this graph, except for maybe growth rates above 6.5%. For the most part, we see a fairly scattered graph, proving that growth rate matters less than the sequence you experience that growth rate. For instance, I circled two distinct periods here in green and red. With the green period, we see a growth rate of about 4.5%, and that supports a withdrawal rate of about 8.5%. Compare this to the red circle where we see a 6.3% growth rate, but this higher growth rate only sustains a 4.5% withdrawal rate. The red circle has an almost 2% better per year growth rate, but supports almost half of the spending. How is this possible? Sequence of returns matters more. We can pick out another two periods to highlight and show a very similar dynamic here. Here I've highlighted 1950 and 1966 as they have very similar growth rates, but wildly different withdrawal rates. For the 1950 simulation, the real growth rate was approximately 3.9%, but this lower growth rate allowed for approximately an 8% withdrawal rate. Compare this to retiring in 1966, and you would have actually earned a higher growth rate through those 30 years at approximately 4.1%. However, this wouldn't have translated into a higher safe withdrawal rate as they would have been able to only support 3.7%. Napkin math would say this is impossible. Real world math would highlight an important concept you need to understand. Volatility and sequence of returns matters more than the overall return itself. A bad sequence of returns cannot be overcome by higher average returns. Now, thus far, we've been narrowly focused on retirement, but know that all of these dynamics that we've been discussing so far also apply to decisions around loans and mortgages. Retirement and taking out a loan to earn a spread are incredibly similar situations. You have a pot of money, and in both cases, you are needing to withdraw from that pot of money. In retirement's case, you are withdrawing that money, obviously, for spending and the income that you need to survive. In the loan case, you are withdrawing money because you are contractually obligated to pay back that loan that you took out. Both situations are distributing from portfolios, and because of this, you can throw the napkin math out the window in both cases. This paper is a few years old, so mortgage assumptions have obviously changed wildly, but a company called Honest Math did a great analysis that further proves how misguided napkin math can be. Within this analysis, they showed how likely you are to come ahead taking out a mortgage and try to earn a spread. In the specific simulation on the screen, they assumed a portfolio was going to earn a little over 5%, and the interest rate on this mortgage would be 3.5%. So napkin math would say there's a bit over a 1.5% spread that should be earned from this type of situation. If we updated this to reflect maybe current interest rates, this would be akin to taking out a 6.5% mortgage rate while investing in a portfolio earning around 8%. Napkin math says this should be a no-brainer decision. Real world math says you have a 46% chance of losing money by taking out a mortgage. Now, some investors may be willing to take those odds, but this is hardly a clean-cut scenario like the math to nap would indicate. Let me try to reframe this by showing this in a slightly different lens. As of recording this video, average mortgage rates in the US are around 6.25%. For the sake of easy math, I'm just going to assume we're looking at purchasing a $1 million home, and we are considering whether to just pay for that home from our portfolio or whether we should try to take on a mortgage and earn a spread. On a 30-year loan, the monthly payment for this mortgage would come out to almost $6,200 per month. Annualize this out for the year, and it comes out to almost $74,000 in loan payments, covering both principal and interest. Using some pretty straightforward math, this means your $1 million portfolio would need to sustain an almost 7.4% withdrawal rate. Based on some of the data that we've covered on safe withdrawal rates in retirement so far, how comfortable would you be entering a retirement needing a 7.4% withdrawal rate? Sure, we could certainly cherry pick some historic periods where that would have been sustainable, but across all of the data we've covered, it's quite unlikely that you're going to come out ahead by trying to take out a mortgage and earn a spread. This highlights some irony in Dave Ramsey's napkin math. If we propose this as a retirement scenario, he would tell you that you could easily sustain a 7.4% withdrawal rate because your portfolio, as you said in the clip, is going to earn 12%. And so taking only 7.4%, you're going to have about 4.5% left over from growth. But if we flip the context of the situation from retirement to taking on debt and trying to earn a spread, he would likely wonder just how dumb you are for thinking this is a good idea. The irony is so thick that you can chew on it. So what have we covered so far? First, napkin math is quite misguided and can be easily disproved by just digging a little bit deeper. Second, sequence of returns matters more than the overall returns that you experience. Third, when we are considering things like taking on debt to earn a spread with our portfolio, this is a situation that is incredibly similar to retirement math, and we can use some easy spot checks to see if taking on that debt is really a good idea. From here, I want to offer a few solutions you can use in your financial picture to try to minimize the effect of sequence of return risk in both retirement as well as debt decisions. The first way to minimize sequence of return risk is a bit of a brute force solution. Spend conservatively and get the math working in your favor. Yes, higher withdrawal rates like 5, 6, or even 7% are sustainable in some portion of historical simulations, but they mainly fail because they open you up to more sequence of return risk. Given this, many investors can solve for this risk by simply growing your portfolio to a point that you have a more conservative withdrawal rate. The 4% rule became famous because historically it's been a low enough withdrawal rate that you would have survived every 30-year simulation. In a scenario like 1966, you barely had enough money left at the end of those 30 years. In all other situations, your wealth grew quite well. If you're a conservative retiree that wants to overcome sequence of return risk, getting your portfolio to a point where you can afford to live off 4% or 3.5% or 3% will almost certainly ensure sequence of return risk does not crash your retirement. Regarding loan math, if you're able to lock in a low enough loan rate, like what we saw a few years ago during 2020, you will now put yourself in a situation where earning a spread is almost guaranteed. Mortgage rates back then were so low that historically speaking, interest you could earn on money markets or treasuries is higher than your mortgage rate. It wouldn't have been so back then, but obviously wait a few years for those rates to come back to normalcy, and it would. So in that context, sequence of return risk isn't a risk because you can earn straight line returns by using those fixed income vehicles. Strategy number 2 is to lower the volatility in your portfolio strategically. The reason I say strategically is the strategy is path dependent. For instance, let's say that you were 100% stocks right up to your retirement date and you retired right after a massive economic downturn like 2008. Your portfolio is already down greatly. You've already experienced that sequence of return risk to some degree. This would probably be a bad time to shift a bunch of your portfolio to safe assets because you already experienced the loss that you're effectively trying to protect against with adding more safety to your portfolio. But outside of this, if downside volatility is the main issue in sequence of return risk, then we can simply invest parts of our retirement portfolio more safely in order to avoid that downside volatility. There's a strategy I covered in a video a few years ago that has a lot of interesting data behind it. It's called a reverse equity glide path. Many investors are familiar with traditional glide path investing. This is the type of investing target date funds use. As you age, you add more to safety. A reverse equity glide path reverses this. At retirement, you start with the most safety you will have, and then as you age, you increase your stock exposure. The reason this does a great job at minimizing sequence of return risk is because it prevents big downturns in those first 5 years of retirement, which we've already shown are the most important or influential. Here's a table from a paper that highlights this strategy and shows that on average, a reverse equity glide path is much safer than a traditional glide path and even safer than just trying to keep the same growth to safety allocation static through your retirement. The main reason for this, as we've mentioned, starting retirement with a safer allocation greatly minimizes the negative effects of a sequence of return risk. Then as you age, you increase your stock exposure. You are able to handle more risk and volatility because negative returns later in life aren't as detrimental. Then strategy number 3 is to use a flexible spending strategy in retirement. If you are willing to adjust your spending down, if you experience that negative sequence of return risk, this is another mechanism that will keep your retirement safe, or at least allow for a greater probability of safety. For instance, I have a stress test on the screen for a couple in their 60s with $2 million in assets and some reasonable Social Security benefits. They start their retirement spending $11,514 per month, but they retired right before 2008. This would be considered terrible timing in the context of sequence of return risk. However, they were flexible in their spending strategy. Their spending program showed that during this big portfolio decline, they would need to adjust their spending down about $14,000 per year. They would need to keep the spending lower for a multiple year stretch to give their portfolio some relief and allow it to recover. Once their portfolio did recover, they were able to raise their spending back up, but that lower spending for a period of time ended up making a big difference. Napkin math makes retirement look easy right up until it quietly breaks. The uncomfortable truth is that higher average returns can't fix a bad sequence of returns, and no amount of confidence changes that math. That's why good retirement planning isn't about chasing performance. It's about building a strategy that survives volatility, bad timing, and real-world uncertainty. If you want a retirement plan that's built around real math instead of just shortcuts like napkin math, and you want to pressure test decisions like spending rates, Roth conversions, or whether debt actually helps or hurts you, you can find a link below this video with our contact information, potentially start that process with us. Always remember, you don't need more money, you need a better plan. I look forward to seeing you in the next video.